We're going to get started with our fourth panel on fintech and financial federalism. And as our moderator, we have Joe Colangelo, who is the president of Consumers Research. Thanks very much.
Hi. It's a real honor to be here. Thank you, Naomi. And can everybody hear me all right? Can everybody hear me in the back? Excellent. So far today we've been talking about how to kind of divide and regulate the banking system that is based on, etching figurative notes and numbers onto the cave wall compared to what we're going to be talking about in this panel. So while you're all talking about how the past has worked and will be regulated, there's a bright future, argues J.W. Verrett, that has nothing to do with the past. And it deserves its own set of regulations that doesn't have to do with the CFPB and doesn't have to do with anything that's come before it, or close. So we're going to be talking about the OCC a little bit. This is a less controversial office, and maybe for that reason they've decided to kind of jump to the forefront of regulating fintech. And so without any further ado, J.W. Verrett, please tell us what fintech is, why we should care about it, and what we should do about it.
Well, I won't presume to tell you what fintech is, because that's the province of Jerry Brito, my friend on the panel, but I will tell you the legal and regulatory barriers to development in the fintech world that I foresee, and that I foresee causing dangerous damage to the financial system unless they are remedied post-haste. My thinking about the post-Dodd-Frank era, the regulatory response to the financial crisis, and the promise that fintech offers to accomplish what Dodd-Frank never could, reminds me of the sort of old, I guess it's a parable about the man who tried to cheat death by having a servant dress up like him and answer the door with his name. A man knew death, with the Grim Reaper was coming for him. It was foretold, his fortune was told, so he tried to set up his servant, and he went over to the next town. So he had his servant answer the door. When death came, death was taken down, and death did come. And the man answered the door, and he gave the name of his master. And Death says, oh, wow, that's incredibly weird, because I have an appointment with him in the next town. I just stopped for a drink of water real quick. The idea being that the seeds of your own destruction are sown in your attempt to avoid it. And I think that's what the Dodd-Frank Act did. It doubled down on the Basel-based regulatory approach, capital-based regulatory approach, combined with government-backed insolvency proceedings that precipitate moral hazard. The Basel capital approach that preceded Dodd-Frank and then was just sort of juiced up post-Dodd-Frank is designed to ensure that banks all invest in the same sort of stuff, and so when they fail, they all fail at the same time. They intermediate finance in the same way. It is a model, it is a homogeneous regulatory model that encourages a homogeneous business model. I think fintech promises to break all of that. And though creative destruction is messy, it's also the heart of our capitalist system. So I see incredible promise ahead with fintech, taking down the old sleepy dinosaurs in ways that not only provide surplus for consumers and producers, but also limits the hazards of systemic risk. Think about this, for example. The underlying logic of federal deposit insurance is that the type of financial intermediation that banks do is very run-prone. Banks engage in essentially duration transformation. They borrow very short and lend very long, which makes you inherently fragile, right? And if runs happen by the providers of finance, by the commercial depositors, then everything is sort of destroyed. Well, bank runs are all about an information cost problem, about a collective action problem. If all the people who were going to run could get together and have some insurance that they'll all wait a little bit, then you minimize the risk of runs. I think it's possible, it's not entirely pie in the sky, that the blockchain technologies utilized by some of these fintech services providers can help sort of the providers of short-term finance to watch each other, to develop gates and fee type arrangements that delay the ability of demand depositors. Don't completely forestall, but delay the ability of demand depositors, short-term financiers, to obtain access to their short-term financing in ways that are variable, that aren't fixed, and relative to the pressures on the system. That can, I think, help serve as sort of governors on the giant mechanism that keep it from all imploding whenever there's a bubble in the underlying assets that banks invest in, which is usually real estate. But the promise of fintech is incredibly constrained by the existing regulatory structure, unfortunately. So let's assume, for example, let's assume that someone at MIT has the fix, has the code, the technology to end runs on deposits for good, forever. Let's assume I go meet that person, and the lawyer's job in the room is always the one who brings pessimism and despair. And I would do exactly that to our innovator who wants to solve the problem of systemic risk forever, because I would tell him, that's great, you got a great idea, how much have you raised? Oh, $10 million, okay, that's terrific, because you're going to need it. Because you're going to have to register with all 50 states as a money transmitter. You're going to have to worry about, if you partner with banks, you're going to have to worry about the FDIC's new rules about bank partners. You're going to have to worry about the CFPB. Oh man, we could talk all day about the CFPB. They have a program called Operation Catalyst that's designed to allow fintech providers to go and get some assurance through a no-action process. But nobody's used it yet, because when it was rolled out, Director Cordray said we expect that only 3 or 4 entities per year will use it, dramatically lower than any used in any real innovation development model at any regulatory agency. We will not provide any assurance that we won't go after you later. Our culture at our firm is very much, at our regulatory agency, is very much anti-business. I could go on and on about the CFPB. And then you have state attorney generals. Let's talk about the Martin Act and the risk proposed there. And the fact that even if you can get this new thing, the OCC's thinking about, a fintech charter, it's not really going to give you much of an advantage either, because the OCC has limited ability to preempt the states. So I would probably convince my MIT friends who've solved systemic risk to just go ahead and take that job at JP Morgan instead. I have an idea for a world that's different, for a world that can work better. And at the risk of falling into the same mistake that other libertarian idealists have fallen on, if you haven't read the book, Radicals for Capitalism, you should. It tells the story of some libertarians who try to start a libertarian utopia. So they go out, one group goes out to Micronesia, they get some financing, and they start a little village. And another group of natives come over and beat them up and kill them and take all their stuff. So then another group tries to start a libertarian utopia on an old abandoned oil derrick. Basically they all get sexually transmitted diseases, and they start to beat up each other, take each other's stuff, and those that don't come back starve to death. So at the risk of creating another misinformed libertarian utopia, let me suggest to you what the future should like for fintech regulation and fintech chartering. It should be developed inspired by the state-based system of corporate chartering, which is competitive, and which is competitive only because of something called the Internal Affairs Doctrine. Basically, for the most part, get your charter for your company in one state, and all the other 49 states have to recognize that that one state, and that one state alone, serves as the primary regulator of the relationship between the shareholders and the entity itself. And so you have states competing with each other in providing a regulatory scheme for regulating that relationship. In much the same way, I would suggest a similar approach in which, say, Delaware or Connecticut, usually it's a small state because small states care about this relative revenue generation more, but Connecticut or Delaware gives the fintech charter and regulates the relationship between what are in some way providers of short-term finance. It won't be quite like the deposit system, because fintech has all kinds of other ways to intermediate finance and facilitate financial intermediation. But in some way, to the extent there's a need to regulate the relationship between the providers of finance and the users of it, the states will do it, and the states will compete with each other. I think that's a much better system than what is currently being considered by the OCC, which isn't bad. What the OCC says right now is basically, we want to give you a fintech charter. It'll allow you to receive some preemption of state law, though not really the preemption you need, because recent case called Madden v. Midland and Cash Call both sort of eliminate, but we'll give you some preemption. You're still subject to the CFPB. We're still going to regulate you in the same way we regulate banks, even though you don't take commercial deposits. We'll still apply capital controls. And we'll still, importantly, I think, apply, and this is the craziest thing I've ever heard in the world, we'll still apply the Community Reinvestment Act to you, which is odd, right? If you're an online lending platform, you don't make loans, you take loans and you create an exchange where people can buy and sell them. There's no way for you to direct money to low-income communities through what you're running, but nevertheless, in a complete twist of logic and good sense, the Comptroller of the Currency has said he will apply the Community Reinvestment Act to fintech chartered firms. So I don't hold out much more hope for the fintech charter by the OCC than was accomplished through the CFPB's ill-fated Operation Catalyst. But I do hold out hope for the possibility of a libertarian utopia under, if anyone in the new administration is willing to listen to the ideas in the paper that inspired my talk today. Also was kind of a secondary thesis if we want to be pragmatic, and as an academic I don't usually like to be pragmatic, but I think in the OCC's charter, the OCC does have authority, and this is an aggressive interpretation of Dodd-Frank, but I think the OCC does have the authority to say, well, we're limited in our ability to preempt the states, but if we just choose headquartering states' consumer protection laws and we stop the other 49 states from using it, I think you could arguably say that's not preemption, that's just prioritization of one state's rules over another. I'm sure no one at the CFPB would agree with that right now, but I think I'm right, and I'd be willing to help the new OCC litigate that in court. It would provide some of the advantages of competitive state federalism, though not most of them. So if you want to be pragmatic, that's sort of the secondary thesis I'm offering. So again, I don't know anything about fintech. Neither does any lawyer at any one of these regulatory agencies. But I do know about barriers to entry created by agencies and fostered by incumbents. And I do know something about competitive federalism in the corporate law sphere that I think could be transplanted into the sphere in a positive way, particularly because, for the most part, these fintech firms are not going to get access to the federal deposit insurance or the federal safety net otherwise, which I think limits some of the distortive effects that have inhibited competitive federalism in banking. That's my piece. I'll let everyone else sort of talk about why I was wrong, and hopefully Jerry can tell you a little bit about what fintech actually is. But thank you for listening to me.
Thank you. So Heidi, we have a unique set of alliances now between the people who are, well, I guess for the first time, the people who are advancing these libertarian, often libertarian startups or startups that are trying to throw a brick through the window of the old banking system. They are generally in favor, in most issues, in favor of federalism and states' rights. But for this, there's been a large cry in the Bitcoin community, and Jerry can get to that later, for federal preemption. Why do we have this dual banking system? What do you think of some of these ideas, and what do you see as the current and future state of this fintech regulation?
So, Joe, I'm thrilled to actually get a chance to talk about the dual banking system. It's if you're a banking lawyer like I am, it's not something that you generally get a group of intelligent people to actually care about. It's a pretty archaic system that grew out of the Civil War. As many of you may know, banking before the Civil War was a state bank. State banks issued notes that was the equivalent of what we think of as money today. And to finance the Civil War, the federal government created the Office of the Comptroller of the Currency to create a federal currency, and we ended up with the dual banking system. Well, the interesting thing is today, the dual banking system, which allows banks to be both chartered at the federal level or in the 50 states, is often praised as a great system of regulatory competition and thus innovation. But of course, it was never conceived of that as that. The purpose of it was not created in order to create competition or regulatory innovation. And in my opinion, it shows. So it is praised for that, but I don't think there's any evidence that the dual banking system really creates much good regulatory tension between these different jurisdictions. So in JW's paper, which I recommend to all of you, he points a lot to the benefit of the federal charter being the OCC's ability to preempt certain state laws. And that certainly has given the OCC over time a tremendous advantage over state bank regulators because the state bank regulators don't have the same authority to preempt other state laws. But the interesting thing about the dual banking system is it's not, the preemption is not the beginning or end of the story, because if federal preemption was so powerful, you wouldn't have almost 4,000 state banks as you do today. We still have those state banking institutions. And so the question of competition between the states and the federal government over bank regulation is really much more complicated. And in fact, many community bankers would probably tell you that a prime place for competition among these various jurisdictions is simply in the fees that are charged for examinations. So the OCC, we were talking about funding of agencies quite a bit in the earlier panel. The OCC has independent funding. Its funds derive entirely from fees that it charges to the banks it regulates. So when a national bank is examined, it has to pay for that examination. Whereas state chartered banks at the federal level do not pay for their examinations. This is because the FDIC and the Federal Reserve, who are the federal level examiners for state banks, have independent sources of funding, so they don't charge for their examinations. So in this regard, and at the state level, the fees charged for examinations are relatively much lower. So in this particular regard, in the dual banking system, the states actually win, which is interesting. But if we look over time, there have been lots of other battles, and some of them are just strange. So I think back to 20, 30 years ago, when rules regarding restrictions to loans to one borrower, which is something that fintech companies are probably going to come up against. There are federal and state rules that restrict the amount of money that a bank can lend to one borrower, and obviously one borrower has a definition. A prime place for states to compete with the federal government. Lots of room for innovative ways of thinking about that prudential regulatory tool. And yet, many states simply adopted the federal standards. So they just opted, not to compete. Why? I don't know the reason for that, but I certainly do know that just because there is an opportunity for jurisdictions to compete doesn't necessarily mean that they will. I'd like to, arguing over and utilizing bank charters for industry advantage or disadvantage has a long history. The dual banking system is just one example of that charter debate. I wanted to share with all of you just a bit of a more recent example regarding bank charters and how they've been used in sort of more innovative ways, and see if it gives us any sort of way to look at fintech charters and sort of predict what might happen with them. So some of you may be familiar with this special kind of bank called an industrial loan company. And I'm actually going to be talking about Walmart, who Todd Henderson referenced this morning. So industrial loan companies are banks that aren't considered banks under the Bank Holding Company Act. And before you fall asleep listening to that, let me just quickly tell you that what that means is an industrial loan company is a bank that can pretty much act as any other bank does, but can be owned by a commercial enterprise as opposed to a financial institution. The Bank Holding Company Act prohibits commercial entities from combining with banks, the concern being, accumulation of power, conflicts of interest, et cetera. But there's a loophole, and there's several loopholes, but an important loophole is the industrial loan company. So there are many commercial entities out there that own banks, Target, BMW, Nordstrom, Volkswagen, GE, GM, and they've done so through this loophole of the industrial loan company. They're chartered primarily in, they're state chartered banks. Utah and Nevada, I think, are the big states that are active in this area. Well, early in the 2000s, Walmart decided they wanted a bank. So they put in an application for an industrial loan company. This drew lots of criticism. At the time, Walmart was the target of lots of public outcry. And the result was that the FDIC, which is the federal regulator of industrial loan companies, refused to act on the application and in fact self-imposed a moratorium on all new industrial loan company applications. Dodd-Frank comes along, the financial crisis comes along, there are bigger fish to fry, and in Dodd-Frank there is a 3-year congressionally imposed moratorium on industrial loan companies. That moratorium expired 3 years ago. No surprise for anybody that watches what's been happening in bank chartering recently. There haven't been any new industrial loan companies chartered by the FDIC, and who knows the reason for that. The result being that Walmart does not have a bank in the United States. I believe it at one time anyway had a bank in Mexico, but there isn't a bank in the United States. So what do I take from that sort of Walmart experience? Well, first of all, we, in some ways, lost an opportunity to see what would happen if you had a big retailer like Walmart competing with large banks. I think I didn't necessarily support the idea, but I think it would have been very interesting. I would have liked to have had that information to see what that kind of competition would look like, because there are so few entities that can compete with the large banks. On the other hand, Walmart found other ways to do what it wanted to do. In other words, Walmart now has every right to revive that application. I don't know that they would receive the same public outcry as they did at the time, but they've figured out other ways to achieve whatever business goals they had that they were trying to achieve through the ILC charter all those years ago. So maybe they found better ways to achieve their business goals. We really can't know. In some ways, the sad part of the story is that the FDIC, who I mentioned, was the federal regulator that issued and regulated the ILC banks, really only put a moratorium on the Walmart application because of the public outrage over it. The FDIC had long taken the position that it was well equipped to supervise industrial loan companies, and that it had had a long, very strong track record of doing so. In fact, I think it's true, but don't quote me, I think it's true that no ILC has ever failed. And so the only reason for the FDIC's self-imposed moratorium was really the strong public debate. So I guess what I get out of this is that I certainly hope that Walmart does not decide to try to own a fintech company, because if they do, I think that would be just the type of thing that could really set back any hopes for finding ways for these innovative companies to begin to offer benefits to customers.
Thank you very much. So on a scale of 1 to 10, 1 being I know nothing about Bitcoin, 10 being I know as much as Jerry Brito about Bitcoin, who thinks that they're above a 4 in this room? All right, Jerry, you got your work cut out for you.
All right. Well,
all yours.
But luckily, you don't have to understand how Bitcoin works to get the OCC and FinTech. So I'll get into a little bit in a minute. So I'll say a couple things. So number one, despite what's been advertised, I'm not an expert on FinTech, although I appreciate the attempt. I'm an expert on digital currencies, which is a tiny sliver of the FinTech space. And I think what I'd like to do is just give you a view into what it is that innovators in that space are facing when they look at the regulatory landscape and why the OCC chartering process has been so important. So look, if you are a digital currency firm, in particular a Bitcoin or Ethereum or Zcash firm, you're an exchange, you're a payment processor, when you go to your lawyer, you're starting up, and you say, okay, what do we need to do for regulatory compliance? What you'll be told is that you are likely a money transmitter. And if you're a money transmitter, this means that you need to get a license in each and every state in which you do business, which means all 50 states. Because these companies, by their nature, because they are internet-based firms, they're global on day one. If you're talking about barriers to entry, the fact that you have to get 50 licenses, that you need to comply with 50 different bonding requirements, submit 50 different sets of fingerprints, you need to submit yourself to 50 different examinations a year. That is a big barrier. But that's a big barrier for just about any fintech firm that might be a money transmitter, which is a lot of them. The bigger issue for digital currency firms, for Bitcoin firms, is that Bitcoin is different than your traditional, sort of financial product. And as a result, it's not clear whether you fit the laws, the money transmission laws that exist. Let me give you some example of what this might be. So with Bitcoin, for the first time, you have digital scarcity. That was not possible before the invention of Bitcoin. When you own a Bitcoin, you actually own it yourself and you hold it yourself, right? You hold a cryptographic key that actually controls the asset. And if you have that key in your possession, it's like if you have a dollar bill in your possession. It's not with anybody else. So as a result, you have Bitcoin firms that will hold that cryptographic key for you. They hold custody of your digital currency for you. And so as a result, they look a lot like a bank. So of course, they need to go get a license, they need to get registered, they need to get a license and do all that good stuff. Of course, they got to do it 50 times over, which is a barrier to entry. But you'll have other firms that simply provide software that allow you on your own computer to hold your own money. As a result, these firms cannot possibly lose your money, cannot run away with your money, cannot be hacked and have your money stolen. So the policy rationale, the consumer protection policy rationale for licensing goes away. Yet, if you read the money transmission statutes, money transmission, which requires licensing, is often defined as the transmission of money. What does that mean? All right, so if I'm offering you a website that allows you to, using your own credentials, move money, but never take possession of your money, do I really need a license? And so when you go to, for example, to the Department of Business Oversight in California, and you say, hi, I'm a digital currency firm, I'd like a money transmission license because I think I need one. They'll say, we're not sure. Can you come back later? And you say, okay. And you come back later, maybe 6 months, and they're like, we're still thinking about it. In the meantime, you're operating, right? And I moderated a panel with the head of the California DBO, and I said to her, she said how we need to develop a way to account for these firms, et cetera. And I said to her, so are you saying now, though, that these firms do not need to get a money transmission license? She said, oh, no, I'm not saying that at all. So they won't give you one. They won't say that you need one, but they won't say that you don't need one either. And so you are in this sort of netherland, and multiply that by 20, 30 states that kind of are in the same spot. At the same time, states are proceeding in developing either digital currency licensing regulations or amending the money transmission licensing laws in a way to take account of the new virtual currency technology, but doing so in a way that doesn't really understand it. So for example, with digital currency, for the first time you can have divided control of an asset. And so what this means is that you can have an amount of digital currency in a digital currency address, say 100 Bitcoin, and you can have 3 keys control that money. And those keys can be divided among three persons. Catherine, Jerry, and Heidi can have 1 key each, and you need at least 2 of those keys to move any of the funds. This is not like a joint account where any one party could just move the money, could tell the firm that's holding the money to move the money. This literally is divided control of an asset. Nothing like this has existed before, right? So if you have a firm that has 1 out of 3 keys and the customer has 2, does that firm hold custody of the funds? Do they need to get a license? Arguably not, because again, with 1 key, they cannot lose the money. They cannot go out of business and put you at risk. They cannot be hacked and have your money taken away. And yet, there are laws today that are being developed that may still require those firms to have licenses. So anyhow, that's a long way of saying this is what an innovator coming to the market faces. And by the way, this doesn't just affect businesses, this affects academics and users who just write software and might find that they need to find themselves in the crosshairs of the licensing regimes. So I fully agree with JW that the ideal solution would be to have Congress create a regime where there's competition among the states, where you can get a license in your home state or in any state that you choose and then have that be passportable, right? This is the way it works in the EU, and we can get into that later, what that looks like. That's ideal. In my former life as an academic, I focused on the ideal. In my new life, where I'm more focused on getting policy change actually made, pragmatically, I think there are a lot of obstacles to getting there. So when the OCC comes along and says, we're considering creating a charter for fintechs that would preempt the states, that's music to our ears. Because what this means now is that a firm can go to one place and they're good to go in every state. It also solves some access to banking issues that Bitcoin firms have. And if we get it right and we can get some federal safe harbor rules to go along with it, it could clarify the rules for all those folks who should never be required to get a charter or a license, right? And what I like about the OCC charter, as it's been sort of semi-proposed at this point, is that it's a new option, it's a new alternative. It does nothing to the existing 50-state regime. That's in place. If you still want to start a firm and go state by state and get a license, that's still an option. And it's still an option for Congress to come in and do what you're suggesting. But the OCC now is creating a new alternative. And look, I think there are many, the devil's going to be in the details as that's developed. But I welcome at least their foray into this. So why don't I stop there and we'll have more discussion.
Well, the devil is in the details, and Kate, Judge, would you be able to share some of those details, things that they should get right, and what they might be getting wrong?
Well, I'll do my best. I'm actually, again, I think I was encouraged to speak a little more big picture, and I realized I was going to be the last person on the last panel. So to keep you awake, I decided I need to have a few slides, and since I don't know my slides that well, I'm going to stand right here where I can see them. But I'll try to keep it brief. So I was asked to look a little bit picture and to look ahead, but again, I'm using JW's paper as the springboard for my comments. So one of the things I want to start with is what is the potential of this industry? So according to JW, fintech firms promise to completely reshape the industry. We saw him say something similar here. He's certainly not alone in this view. And I want to say we don't really know. And this is not to minimize the disruptive potential and the importance of that disruptive potential that fintech, broadly construed, potentially embodies. But as Bill Gates famously said back in 1994, he foresaw the demise of banking in the near future more than 20 years ago, and we haven't seen that happen yet. And again, I think that matters for the regulatory question, because if you look at the proposal as it's out there, the question isn't, do we want to facilitate innovation and make it so we don't have a competitive playing field that is tilted too heavily towards the existing participants. I think we'd all find that incredibly troubling, and I think that is part of the challenge we face today. But the proposal is we should have a really big thumb on the scale that gives them a whole variety of freedom and flexibility that we don't allow other firms to have. And so I want to say is I don't know long term where they're going to offer efficiencies, where they're going to offer advantages, and where they're not. So I like things like the toolbox approach that we're seeing in the UK that says we're going to do things a little bit lighter to begin with. We're going to facilitate their initial creation. But long term, the aim is to create more of a balanced playing field. So it's actually the market, rather than the five of us, who decides who's ultimately going to be kind of the winners in the competition to come. And again, just the one example of this is we've seen this already in the evolution of what had been peer-to-peer lending and what is now known as marketplace lending, as described in the paper. So the original hype around it, which was not all of that long ago, was that this was going to completely transform how loans were created, and it was going to increase access to credit. It was going to change who had the ability to invest directly in these loans, and it was going to change the nature of the intermediation chain that resulted. So the idea was that if you're a borrower and your credit isn't very good, using the traditional metrics like credit scores, well, those traditional metrics we know are imperfect proxies for whether or not you're actually creditworthy. So what we're going to do is allow you to sit down at your computer and tell your story and say, here's who I am, here's why I'm a good credit risk, and here's why you should loan me money. And then we'd have all of these individuals sitting at home, reading through these different stories, and they're going to use their personal judgment to decide who's actually creditworthy. And then after they made these determinations, we'd have a direct relationship where I was a lender, Joe was a borrower, and now rather than this long intermediation chain through this distant entity, there'd be a direct tie between us. What we have seen, even though this has grown and clearly has shown that there's room for significant improvement in our lending practices, looks nothing like that. So first of all, it turns out individuals are not very good at figuring out who's actually creditworthy. There were a lot of bad loans extended when people were relying on these narratives. And so now what we're seeing is that the people who are getting loans and the mechanisms that are being used to determine who gets loan look a lot like the metrics that have traditionally been used in credit underwriting. It's not all that surprising, but it looks very different. And as a practical matter, most of the money isn't coming from individuals who now in theory would have the ability to invest directly in this new asset class. It's coming from large institutional investors, and therefore these loans are now being baked in these very long intermediation chains. I don't think this is a bad evolution, but for me this is a sign that the promise of here's what we're going to get is oftentimes not where we're actually going to end up. So I don't want to have any assumptions over where we're headed that are going to shape what we want in terms of the regulatory schema. That being said, there's a lot of areas where J&W and I really do agree. So first, and I'm not going to belabor this point because Jerry just made it so nicely, this is not a domain where sitting on the sidelines is going to create the optimal level of innovation. This is a space that is already heavily regulated, and for those firms that are engaging activity that might or might not actually fall into what is currently the regulatory umbrella, fears that they might can actually deter activity and deter innovation. So I agree that this is an area where we can't just sit on the sidelines and assume that the market is going to figure it out. And a challenge beyond that is one that in some ways is a very classic challenge. On the one hand, I say legitimate policy issues, you could disagree with that, but these are issues that Congress has said, or that states have said, these are issues that we care about and we want to try and protect. And so they've created numerous different overlapping regulatory regimes that are trying to protect these various interests. But there's also reasons to be concerned that what we're going to get if we just allow regulators to continue doing what they're doing isn't going to be an optimal level of innovation. And again, this is where JW and I really agree. So reasons we might want to push the regulators a little bit to facilitate the optimal level of innovation, one are just traditional concerns about regulatory capture, and this is summarized very nicely in the paper, but this is a perfect area to be concerned that the bias of the regulators towards the entities that they regulate is going to result in a degree of protectionism. Another is an issue that I've written about in other places, which is this concern about intermediary influence. I'm not going to spend a lot of time on it here, but when the activity that you're engaged in is that of an intermediary, you're reducing transaction costs that would otherwise exist. We see over time, again and again, that the entities that are playing these roles end up with a variety of informational advantages and positional advantages that allow them to entrench institutional forms that are not as efficient as viable alternatives for longer than they should otherwise exist. So this wouldn't necessarily kill fintech, but there's reasons to be concerned here that it's going to impede the rate at which we get a movement towards what might be actually better institutional design in terms of this process of intermediation. Along with these informational and positional advantages, another factor that tends to weigh in here is industry structure. And again, we already see this. I think the OCC has actually made a move that I found quite impressive in their recent efforts to create this special fintech charter. But even in that process, when they submitted their original suggestion that they were going to act along these lines, we saw regulated entities responding in these very formal and also very informed mechanisms. So we saw the clearinghouse saying, here are all of the reasons that you need to be concerned. And even now, we have this proposal out there, which I think looks like a great step, but there still has to be a chartering process. And so we're going to see what that actually looks like. How willing are they over time to really promote the adoption and creation of firms that might eat business away from the entities that they're otherwise meant to protect the safety and soundness of, and we don't yet know. And then finally, as everyone here knows, the current playing field as it exists is not the result of market forces playing out and creative destruction that otherwise should have happened being allowed to happen, but rather is the byproduct of the government having intervened in the past and playing a significant role shaping and adding further power to the existing entities. So I both agree with JW that there's a number of reasons that we need to be concerned about allowing the regulatory processes to play out the way they otherwise might in this space. And yet I don't think we need to have any assumptions that fintech is necessarily going to result in a better alternative to say we need to figure out at a big picture level what is the optimal mechanism for encouraging the innovation to the extent it can actually create meaningful value. And this is where the answer that's proposed is one that's really based on federalism reinvoked. And here again, I think my answer would be yes, but. So I really like a lot of the idea that it's out there. I think it's a creative way of trying to think about some of these issues. But I think again, here we have some differences over where we've come from, which I think gives us some differences over where we best go from here. So again, in his view, we've had a federal system that has steadily increased the unavoidable and overpowering centralization of power in the federal government, and that's culminated in Dodd-Frank. I don't think he's alone in this view. The alternative, which I endorse, is it's a little bit different. I think Dodd-Frank actually meaningfully tried to restore power to the states on a whole variety of different fronts. So there's been already a back and forth between where is the optimal level of power, and that's been informed by historical experience. Claim, in order for a non-bank charter system to be competitive, federal law must preempt application of state law to out-of-state charters. Here, for me, I think it's going to depend on the particular state law, which goes back to how Dodd-Frank is appropriately interpreted, or what the legislature should do in terms of the scope of preemption. But there are a whole variety of ways that you can create more robust competition between a federal charter and a state charter, and another is continuing to scale back, as we've started to in Dodd-Frank, on the degree of preemption that we're going to allow federal entities to enjoy. So that's a conversation that we can have. But I don't think the assumption has to be preemption across all of the different fronts as a way of creating a more level playing field. There are a variety of ways to create that more level playing field. And the final thing I'd want us to think a little bit more about are what are the incentives going to be of the state regulators? And as a practical matter, what does their competence look like? And we have state regulation of insurance, and we've seen significant concerns, as we saw this particularly during the height of the crisis, regarding what they actually even knew about the entities that they were meant to oversee. So we have to think, well, what are the competencies of the various entities? And here I'd say we're dealing with a space that looks very different than corporate law in terms of the possibility of externalities. So we might say the fog of systemic risk, but there are reasons to be concerned in some of these spaces that you can engage in activity that does have meaningful externalities. And once that is the case, we have to think, well, what are the incentives, as you pointed out, of a very small state that then have the ability to license activity that could affect actors in a whole variety of other states over whom they otherwise have no jurisdiction. So I think it's a really creative idea, and one where I think it should be the starting point, but perhaps not the end point, over where we should be going in this regulation of fintech and the role that federalism might play in promoting that innovation.
Well, JW, what do you say to that last point? What is to prevent, in this proposal, a bad actor, say Alaska, from sort of racing to the bottom and creating a fintech charter with zero consumer protections? That would be really attractive to a new fintech company. They wouldn't have to spend a lot on compliance, and they'd be able to get off the ground and running fast.
I'm happy to respond to that, and have a few other counterpoints to keep the great debate from
That's what I want.
Catherine going. First, to that point, that's the same argument often made in state competition for corporate chartering that fails to take into account the if you have a truly competitive federalism system, which I would argue is not present in state-based insurance, but is present in corporate chartering, the state will internalize the reputational effects of its regulation. I mean, if Delaware were truly, for example, the worst regulator of the relationship between shareholders and firms, then there would be a Delaware discount when firms go public that are incorporated in Delaware. But in fact, the limited empirical evidence on this shows precisely the opposite, that there's often a Delaware premium at IPO. I think that dynamic would play out as well. Who would give, if Alaska were truly the worst regulator, and so everyone who provided capital to Alaskan chartered fintech firms. Who would ever give capital to a fintech chartered firm? I mean, I think you would read Fintech Daily or whatever magazine, whatever information intermediaries evolved to help people who want to get involved in the system. You'd read it, and they would say, don't ever give your money or interact with or use as a service provider an Alaskan chartered fintech firm. And I think very quickly, I mean, these are folks who read a lot. These are internet savvy people. I think that the costs of information have gone down such that I'm just not worried about race to the bottom, particularly from a sort of consumer protection standpoint. Starting from Catherine's last point to the systemic risk issue, fair enough that financial intermediation is different from the relationship otherwise between shareholders and firms because of the foggy notion of systemic risk, which I think if you learn nothing else this morning is that it's still ill-defined. But what gives me room for confidence that that's not as much of a concern is my assumption right now that fintech firms are not going to have access to the federal safety net. They don't get deposit insurance. They don't get access to the Fed's discount window. That's a good thing. And that limits their ability to compete with the incumbents. But I think they're still going to be smart enough and innovative enough to compete with the slow incumbents and get the advantages of all these things. And I think, frankly, those advantages will make the incumbents a little bit slower to respond, I think. Part of this discussion merits an observation about federalism generally and the sort of knee-jerk reaction among conservatives and libertarians about federalism. I don't sort of worship the idea of federalism as an unlimited good. I mean, the Constitution even envisions federal regulation of interstate commerce, and though that has its own problems, that's still in the Constitution. There's good federalism and there's bad federalism. Let me be more specific. There's competition-inducing federalism, and there's anti-competitive federalism. So when one state, what I'm talking about basically is empowering one state over the other 49 states, essentially. That's the sort of competitive federalism that I think is important. And, you know, look to I think the great writing of folks like, I don't think Mike Grievous here today, but he's made this point in a number of articles that at some points federal preemption is important to help foster federalism. And I think in this space that's one of those places. So I don't think the insurance sphere is really analogous because, again, you have states regulating activities within their own states. You can't, as a general matter, buy insurance in Louisiana for a Connecticut-regulated insurance relationship. And what I'm talking about, competitive federalism, would require that. I think that's the same motivating idea behind a similar suggestion about breaking down state boundaries as a way to replace Obamacare. It's all about competitive federalism. I hadn't seen the Bill Gates quote, but I do know, I have read, earlier than that, in the 70s or the 80s, an article by my dean, Henry Butler, and John Macy, where they made the same sort of observation that the world of technological innovation is just around the corner and the old sleepy commercial banks are going to go down. They made the same observation, I think, 10, 15 years before Bill Gates did. If I'm wrong, what happens? We create this fintech world and nobody uses it. Okay, if I'm wrong. But if you're wrong, we potentially have a fix to the systemic risk problem. We have a way to eliminate the too big to fail banks and replace them with a more competitive system. I think the costs of failure, if I'm wrong, are lower than the cost of failure if you're wrong. We'll continue to debate that. But I also would be wary of confusing the cause of a lack of innovation in non-traditional banking. I mean, I think that regulation's always been a boundary to this. Look at the way the banking regulators responded to the internet era, right? They continued to apply old and completely antiquated concepts in their regulation. Geographic specific approaches to antitrust. Geographic specific approaches to the Community Reinvestment Act, when they become increasingly irrelevant because people less and less need to go to a bank down the street and they can bank over the internet. And that was a problem in the 90s. It's a problem still today. They still apply these old antiquated concepts in how they regulate antitrust and CRA. They still say, oh, well, you opened a branch here, but there was a low-income community down the street. You didn't open up a branch there. That's not the point. The point is they can go online and get, assuming they can afford it, they can go online and get it from anywhere, right? So banking regulators are really bad about adapting to financial innovation. And I think we're at one of those tipping points, similar to the late 90s, where the slope of innovation is potentially even higher. And so the cost of that problem is even potentially higher. I'll stop there.
I was going to cut you off anyway.
Okay.
So Kate, you've got 30 seconds to respond.
All right, well, there's so much to say, so I'll keep it quick.
Give me 45 seconds.
So, I mean, I think you and I both agree that we want to see greater innovation and that we need to have regulators taking a more creative approach to facilitate innovation. So you and I are on the same page there. The question is, do we want to facilitate, ideally, more of a level playing field, where right now the playing field discourages innovation? Do we want to level it up? Or do we want to tilt it excessively in the favor of these unregulated entities? And the way you just put it, you suggested that if we all go to this alternative structure, we're going to end up in a situation where we can eliminate systemic risk. And for me, that's very contrary to my view of the crisis that we just had. Well, eventually, there were spillover effects on all of the major institutions, and that's why too big to fail became a problem. I think too big to fail, the focus on it, is because that is what is salient to the public, and the bailout of those large institutions were salient to the public. And that's what happened in 2008. I think the crisis actually started a good year plus prior to that, but where it started was in the shadow banking system. It was in entities that were relatively less regulated. The money that got then put into the financial system generally did not go to saving regulated banks, but it went to saving entities that were not otherwise regulated as banks, which is why, going back to your other point of are they part of the federal safety net or not, we need to think not only what are the ex-ante rights that they're going to have, or do we have insured deposits, but as a practical matter, what is the likelihood that a government is going to feel compelled on an ex-post basis to potentially come in, because there's going to be disruptive effects that are not acceptable for political or other reasons. And so I think you and I actually agree on a lot of these issues, but the systemic account, and I guess the account of history, that the focus is on regulated entities as opposed to innovative mechanisms as being the sole sources of instability, I think we have slightly different takes on.
Jerry and Heidi, would you like to add anything to this thread?
Sure.
Go ahead.
I don't know where I am in the scale of it, but I just want to throw out one thought to the extent that JW proposes a legislative solution. That if we're going to think of legislative solutions, I wonder why we're clinging to the charter mechanism. So the reason that the OCC has been pushed and interested in thinking about this fintech charter is because that's the authority they have, and because they have preemptive power. So it's something that's amenable to these firms. But I don't know that conceiving the regulation of a fintech firm through a charter is actually the best way of dealing with the regulatory issues that they may present. And in fact, I think that thinking about these innovative firms really highlights so many of the problems with the architecture of financial regulation in the United States in particular, that we have this really bifurcated, complex, overlapping system. And so if we're thinking about legislation, I wish we would think about a mechanism where we weren't relying on a charter, because I hear your proposal being, we would use state bank charters in the way that the OCC proposes to use its bank charters to help fintech firms. So I would rather see a system where we were looking at what risks needed to be regulated and came at it that way. But with respect to the OCC's proposal, I actually think, given the authority that the OCC has, their most recent statement, which came out last week, is a very well-balanced kind of approach. So I see them saying, sort of to Kate's point, that no fintech firm that we give a charter to is going to get a pass on consumer protection. I mean, they are going to be held to consumer protection standards. We're going to work with them, but We're not going to try to tilt the playing field too much to their advantage. I read the proposal as saying that they would not apply CRA to fintech firms if they weren't taking deposits, because they don't have the statutory authority to do it. CRA only applies to deposit-taking firms, and I would imagine that some of these firms are not going to be deposit-taking; they're going to be lenders, for example. So anyway, I think that that if you allow us to think about legislation, maybe we could go broader and think of a better solution. But I also understand that you're trying to do maybe a incremental move to deal with this particular problem.
Jerry, over the break, over lunch, Richard Epstein said that the exit option has been effectively curtailed over the last few decades, and of course that's applying to traditional financial structures, institutions. You work in the digital currency space. Can you talk a little bit about whether technology is providing a new exit option and whether that might be a sort of counterweight to regulators?
Sure. I don't know. I think we maybe put too much stock into it sometimes. I'm not sure how viable it'll ultimately be because it's so nascent. But the fact is that digital currencies, in particular cryptocurrencies, which are decentralized, basically create a new ability to engage in the transfer of value and the holding of value and the lending of value without intermediaries, without the need to use a bank, without the need to use any third-party intermediary. And so when you have that, you have no intermediary that you can regulate. Of course, you can regulate the end parties ultimately, but of course there are more of those, and so this raises the cost of regulation. These technologies also allow you to have more privacy, which also raises the cost to regulation. So, whether that ultimately will be what happens or not, I think the jury is very much still out. But yes, this technology today, does introduce a new option for exit that didn't exist before, and that I think is very interesting.
At this point, I'd like to go to questions from the audience. We have about 15 minutes left. Yes, sir. If you could wait for the microphone, please.
I think this is all really interesting. I guess so. I have two questions. I guess for JW here. So if there's first thing is I understand the whole federalism idea is to kind of introduce diversity and allow different approaches to blossom. But if you sort of have maybe a couple, or even one sort of efficient form of regulation, you might expect convergence across states anyways, in which case I would think some of the benefits of diversity that you're talking about might go away. And that may not be an issue if investors are not myopic. They're thinking about potentially systemic risk or these tail events that are occurring. But if they're not, then I'm not sure that necessarily just having 50 states have 50 different systems is necessarily going to be beneficial. And taking it the other way, I say, well, why, if you want to take a super libertarian solution, why stop at 50 states, right? There's nothing really tied to the state anymore anyway. Why not allow private entities to become register as regulators, let them have their own private arbitration system or whatever, and people can decide if they want to opt into that system. I mean, it seems kind of silly to have it, okay, we have 50 states, so why stop at 50? Why not allow local governments to do it? Why not just allow anyone to do it and let the market decide? So I guess one question is saying, is the market, there's still going to be some problems, I think, with diversity. But the other question is, if you're going to take your argument, why not just take it to the limit,
Well, first, I have a couple of papers for you to read, including one that hasn't been published that proposes a city-based chartering system for corporations. So I think Silicon Valley corporations would be really cool, and I'd like to try it. So I've got a paper for you on that. Absolutely, yes. I didn't write that paper here because it just, if you think this is a step too far, that would be a step too far. I wanted to have some tether to something that a new OCC, which I think we'll get very soon, could potentially do, like the headquartered state reference, similar to references already there for corporate governance of banks, which references state law, could be utilized. So I wanted a sort of a academic paper with the pragmatic sidecar. But absolutely, that sounds terrific to me. And I've argued for the same thing in the crowdfunding space as a way to go toward, first, arbitrated corporate law. So I think we might actually share a brain. And city-based incorporation. They both sound terrific to me. And private-based systems sounds interesting, although it's incredibly difficult, because the problem is unless you get all 50 states to recognize the private system, then you don't get the benefits of competition. You end up in the same place we are now, potentially. So that's why you probably need a state to do it, or a state to empower a city, which I'm not even sure is constitutional, but I think is interesting from an economic perspective, because that's the only way you get some constitutional basis for mutual recognition between the states. So unfortunately, a purely libertarian world is difficult to get to. Yeah, so that's interesting. The other point you made was what happens if the competition becomes uniform. I think there'll be some of that, and I don't think that's a problem. I mean, I would go back to Richard Epstein's point in his speech where he said that, it's always dangerous for me to say what I think he would say, but I think he would. Say. I took it the part of the speech about diversifying the approach to developing the right system and sort of having competition in what sort of wins out. I think that's what will happen in what I'm suggesting. I think one or two or three states will win, or maybe even just one. Most states won't even compete. They won't really care. Big states particularly won't really care. But I think, often the criticism I get is, well, no, as a small innovative company, we need a uniform system. I think that's part of how states will compete. They'll find the right uniform system. They won't, try to create some system that nobody wants to use because it doesn't, it's Betamax and everybody else is on a different technology. I think they will, that any needs for technological uniformity, whatever, will be a part of the competitive state system. So I don't see that as a problem. I see that as just equilibrium at the end of competition.
Actually, can I chime in, providing, I think there's actually even a stronger support for JW's proposal than he gave there. And that is right now we're talking about fintech, but it is this incredibly broad category that actually covers all kinds of different firms, because banks, of course, provide all kinds of different services. So we're talking about non-banks providing bank-like services. I mean, what Jerry focuses on is very different than marketplace lending. So one of the, I think, beauties of JW's approach is you could also say different states might specialize in different types of fintech areas. And so that might be a reason you don't get convergence, because maybe you want to have different regimes for different types of fintech firms.
Excellent. Another question? Professor Epstein? Could you wait for the microphone, please, so everyone can hear you?
I'm ashamed to ask, but I do not have, in this situation, a clear conception of what counts as a fintech firm. And I mean, I kind of get that. Is a Bitcoin system a fintech operation, or is it not an operation? Indeed, is it a firm? And I think the answer to that question is no. So can somebody actually tell me at least three categories? What's clearly in, what's clearly out, and what's on the fence?
Well, one thing I know for sure, what's clearly out is...
Chase.
Is taking federally insured demand deposits.
Okay.
That's not a fintech firm. I hope, right? Otherwise you're just a basic bank.
Although they develop a lot of technology. I mean, the big banks.
The technology is used by everybody. You get a better check processing system. That doesn't make you a fintech firm. It makes you a more efficient bank. Okay. So what about the other two categories, which are the harder ones?
So, apparently we don't have a fintech specialist. We don't have a Bitcoin specialist. But all sorts of non-traditional ways of intermediating finance that tends to be about using very recent technological innovation. One example of something that I think is just really cool. Maybe that's part of the definition of it. It's techie and it's really cool. Is
when you see it,
lending facilities that, but I take your point that it's a very nebulous definition right now. I mean, we're talking about non-bank banks. That's really what the OCC is using. It's a non-bank bank, which means it's something that does stuff that banks traditionally do, but it doesn't take federally insured demand deposits. That's the definition of a non-bank bank, and fintech is just like a nickname for that. From the regulatory definition, and of course in industry, the techie experts probably have a better definition than I have.
Are these the people who are making all the mortgages now that the Fannie and Freddie banks seem to be slowing down? That is, they said a majority of home mortgage loans are now issued by non-something or others. Are those people?
I don't believe that's the case. It could be one day. They're starting to do some really weird ways of gauging risk, though, that are cool. So, for example, you can get an app that tracks what you do on your phone, what you spend your time doing, where you go, what you do, real Big Brother type stuff. But you can choose to do it, and then whoever gives you financing uses that to rate your credit risk, rather than using traditional credit ratings. Because they you know, I guess maybe if you IM while you drive or something, you're a bad credit rating. I don't know what it is.
So an example of a fintech that makes mortgages is SoFi. So SoFi makes mortgages to
Who?
SoFi, and it's the name of the company.
An acronym or a thing?
SOFI, it's their company, and they make income to HILA people, which is high income, low asset. So if you're a lawyer and you just started working at Wachtell, but you've got $5,000 in the bank, they will lend you $1 million. Because you're working at Wachtell, you have all the social markers of somebody who's going to continue to earn money. It's not your fault you don't have 20% to put down. They make some of the loan out of a large pool of money that they took from investors, and then the rest of it's made by JP Morgan or Wells Fargo. So they do not want to be regulated like a bank, but they want to continue to be able to make loans.
But that, just to, so that means, in effect, what happens is non-bank banks can have bank shareholders in them, which may or may not have some degree of control over their operation. So is this going to be a migration?
That was in the
Shareholders,
details.
they partner with.
That was
Well, you're making the point that I'm making. There are 16 different ways to put together joint ventures, and some of them will and some of them won't be, but in each of these guys, they're going to have some kind of a residual stake. So if non-bank banks are essentially having bank components built into them, is it a revolution or an incremental change?
Well, so there are two models for the future of fintech. One is partnership with existing firms, and one is innovators like Uber that just come in and smash everything. And I think both are possible. The OCC's new fintech charter maybe is a step toward the true innovation, market crashing, or it originally held that promise. I was disappointed in what ultimately came out of it. The FDIC, on the other hand, has begun to aggressively take the view that if you partner with a bank, we're going to treat you like a bank. Yeah, so to some extent there's regulatory competition, the bad kind of regulatory competition, where the FDIC looks at the OCC and says, you think that's going to happen, but we're not going to let it happen. And then the CFPB is this great wild card, this sort of Damocles that hangs over everything.
So is it revolutionary or incremental? As the rabbi said, you're right.
Right. Well played, Joe.
All right, another question from the audience. John Berlau is hiding behind a curtain back there, but
Thank you for spotting me, Joe.
pay no attention to the man behind the curtain.
John Berlau of the Competitive Enterprise Institute. Wanted to say something in response to Heidi's point about Walmart and the ILCs, and then ask a question. To her point that, yeah, what would we have had, it's a very good one, as far as had Walmart been allowed to compete and had we had an option, would that have been, would banks, the big banks we have now have more room to fail without disrupting the economy had we had competition from Walmart, other well-managed firms? We sort of have the answer to that in the fact that in Great Britain, the supermarket chain Tesco bought Royal Bank of Scotland, and even the Labour government has praised the competition they provided as far as deposits and in loans. So we're one of the only, I wrote a report about this in Milken Institute, and others have noted this, we're one of the only countries in the world that does not allow commercial companies to affiliate with banks or to have their own banking divisions, including, and at the same time, Walmart applied, a unit of Berkshire Hathaway applied, and then was denied as a result of the Walmart moratorium. And I don't know if they've reapplied or not, but I disagree with Warren Buffett's politics, but I don't doubt that he would be great at running a bank efficiently and carefully like he does anything else. So it's a real loss, and I'm glad you brought it up. Now, and I also think in the fintech area, there's going to be big players can play an important role in fintech, just as Uber, somebody being big like Uber played in, tech and transportation. and that Uber, I think of Uber as really practicing when they went in their civil disobedience in the commerce, and there's a proud tradition in civil disobedience in other places where they just had the motto, just do it, and it went there in spite of state laws, and basically became, instead of too big to fail, too big to ban, where even if a politician or bureaucrat wanted to ban them, people were using their services and were happy, so they had to come with some sort of reasonable regulation. But they did it. They basically broke the laws first, and then they made the laws come around to them. And I guess Airbnb in somewhat has sort of done the same thing. Do we see any evidence in financial services of a company behaving like Uber or Airbnb, where they're doing it and they're making sort of the laws, or at least that's looking at the business model, adopt to them?
It would surprise me just because the risk, the taxi cab commission versus the risk of AML sanctions. It's the difference between going to jail and getting a fine from your local taxi cab regulator. So it would stop.
I think the answer is there are absolutely firms out there that are taking the Uber approach, especially in the digital currency space. And I don't know that it's going to end up the same way they work for Uber, where the regulators come around. That said, I think, again, the technology, and it's hard for me to talk about this abstractly. I wish I could had another hour to walk you through exactly how this works. But take the AML instance. There are certain parts of the Bank Secrecy Act, certain requirements that cannot be complied with if you're using digital currencies, because the technology does not create the kinds of records that the Bank Secrecy Act expects a company to keep. So now the regulator, really, when getting down to brass tacks and trying to enforce that, they're presented with a binary option. Either they ban the ability of firms to use this technology completely, or they do what? They amend their existing law to accommodate a new technology. So I think we'll see some of that, especially because the alternative of banning really isn't banning something like a digital currency really just drives the use further underground, so that they have even less visibility, which is goes against what they're trying to do. So that's where I think we'll see some of these Uber type actions leading to change. But otherwise, I think we're going to see what you're discussing, which is some pretty hefty penalties.
Are there any final thoughts from the panelists?
I just want to add on that point. So I don't know if you would call it civil disobedience, but the reason we ended Glass-Steagall was because Citigroup pretty much came up to the edge of violating Glass-Steagall, and that pushed Congress to repeal it. So certainly I think the big banks have the ability to do some of this disruption. And when it becomes profitable for them to do it on behalf of fintech, that kind of technology that they want to take advantage of, I have no doubt that they'll get some of those changes because they're already big enough to have that kind of political sway.
I would tell a different story about. I know that's the common story about Graham Leach Bliley, but I would suggest it was inspired by Phil Gramm seeing in Texas how risky it is for banks to only do banking. How that's the worst kind of financial system to have, because they were all overexposed to basically Texas real estate, and why he thought that he envisioned that the diversification of revenue streams for banks was a good idea. And in response to your suggestion that I'm tipping the scales, I have another paper about that helps my friends in the incumbent industry to become more profitable, I think, that supports some of the ideas that made their way in the Hensel Choice Act, and then basically take a different approach of rescinding the safety net, but expanding opportunities to diversify revenue streams.
I look forward to reading it.
Yes.
Well, please join me in giving a round of applause to Antonin Scalia Law School Center for the Study of Administrative State and this wonderful panel. Thank you.